Hi, friends. Welcome to yet another episode of Stoic Talks. Now, in this episode, we bring you a conversation with Rohit Chauhan of RC Funds. Now, there was a time in early 2000s when we didn't have too many investment bloggers as we have today. I remember reading some of the early blogs, and that's how I managed to get introduced to Rohit's work. I have followed his writings ever since and consider him to be one of the original thinkers in the field of investing. I also think that he is a good inspiration for those individuals who believe that investing cannot be successfully pursued with other full-time engagements. Now, what I like about Rohit is that he doesn't take any investment wisdom for granted and will caution the prevalent thought process. And as a result, he has continuously evolved as a value investor. Today, me and Manish will attempt to capture this evolution. And we get into a detailed conversation on the investment process of Rohit. At the request of Rohit, we are going to keep his video hidden, but that doesn't take away anything from the learnings that you can capture from this conversation. Hope you enjoy this. Let's jump in.
Hey Rohit, welcome to Stoic Podcast.
Thank you. Thank you,
Hey
guys.
Rohit, how are you?
I'm doing great. How about both of you?
All good. All
Great,
good.
great. So, I came to know about Rohit from a friend named Varanya, who is a subscriber of his investment advisory. And he was all praise. And so I made a mental note back then that someday I would like to know more about him and probably profile him in our podcast series if we restart it. And now that we have restarted it, and so here we are. Rohit, let's start with understanding your style drift. Now, we know that you're a value investor, but within that, there are so many distinctions. So, what exactly do you do?
So I started with value investing way back when. It used to be called value investing then. I started in like mid 90s, right? And at that point, the way it started was that, as you know, as most of value investors have kind of stumbled into it. Started with, came across this book about Warren Buffett, right? And those days, he was not the god. He was a god, value investing god in the US, but not known in India. So that's where I started. And usually, when you start and you have an engineering background and a quantitative kind of mind, that's where you start off. So it was whatever he was preaching, quality at a certain price, do your DCF and this and that. That's how I started. And then it has been more opportunistic. So let's say, come to 2003, 2010 kind of time frame, and you could buy quality at a reasonable price. You could, companies like an Asian Paints or a Pidilite at 15, 17 times earnings. So it's been very opportunistic. And then you get the 2008 and 2008 crash, and things are available on the cheap. And these were available for less than cash. But off late, and thanks to quite a bit on your website also, started looking at, not necessarily that I invest based on that, but I started looking at momentum and started looking at technical analysis and all the other. So the thing which kind of hit me was that obviously there are other approaches of investing which do equally well. So there is value in all approaches. But second was the amount of time which each of these other approaches spend, right? So let's say momentum, right? If you look at the basic philosophy, forget about how it is done and what are the returns, but the amount of time, at least the quantitative part, the amount of time which you spend in coming up with a portfolio and the returns you get, is the return on that time is disproportionately high versus somebody doing value investing, right? You're reading books, reaching out to management, doing this, that. It's weeks and months of effort, but the returns are not often are not very commensurate. So it's a very artisanal way of doing it. So again, started off as a value investor, and that's how my blog and everything is. But I'm not, I don't now put myself in that box. My thought process is, look at what works rather than getting too religious about something and too touchy about a specific approach.
You said your effort to reward ratio was skewed a bit, and you realize that it's much higher if you do the other parts of things, right? So when you're looking at that, let's actually, before that, let's bring a chronology to this whole transition also, right? um, just for the benefit of users, I mean, you benefit of the listeners, you have already mentioned it multiple times in your various interviews, but what was the year when you actually started investing?
Again, it's usually never a bright line, right? But I would say 97, 97, 98. So I'm ancient. I'm ancient by most standards. 97, 98. And the maybe some of your listeners may have maybe toddlers at that time, so you can you can guess my age. Yeah, 97, 98. Economic times, just the start of the internet, you can call
Yeah.
it that.
And
So
if
that's
I
when I
am
started.
correct in reading this and what I have seen on your blog also, you started more towards arbitrage, risk arbitrage primarily, special situations. That was one part of your investment profile, so to speak. Obviously, besides the normal value investing. So, is it fair to assume that you were more towards Grahamian kind of investing, or the other part was more towards value at reasonable price, which is Warren Buffett's way of doing things, and the other was special situation? So, what was the mix in the initial part of your career?
Actually, I've been all over the place. So I started, core has always been the Buffett style, or was always the Buffett style of investing. The others, it's always been to explore all possible, opportunities, if you may. So I was looking at special situations. I was looking at Graham type of ideas.
Cecil bargains.
Yeah, no, at that point of time, quantitative, or again, this is a bias which I have seen. I realized in myself, and I've seen in a lot of other value investors, is they almost take value investing as a religion and say trading is not good. I should stay away from momentum. I should stay away. I find it, I mean, I don't find it, uh, smart to do it that way. So right from the early point, started with a Graham, because that kind of, uh, was very natural to me, and I think that was very important. I was comfortable sleeping at night with that. Started a little bit of special situations, but I just dabbled a very little bit here and there on it. It did not go beyond that, because the amount of time and this, mind you, this is while I'm doing my full-time work. So the amount of time and effort one has to put in special situations and all kind of stuff is far more in terms of the versus the return. So I've always been a proponent. I've worked backwards. I have so much time. What can I do? What is the best I can do with the limited time which I have? So the special situations bit of it, the same thing around Graham. Yeah, maybe I can make a return, but it's way too much work. You find pretty crappy companies, somehow buy a boatload of it and hope some of them work. Makes your stomach churn every quarter when you go through their conference calls and their annual reports and everything, and then hopefully a few of them will work out. So that was way too much. I used to think of it like the cow method, right? You eat a whole load of grass, and then maybe a little bit of milk comes out of it. Not my cup of tea. So I kind of gave up all of that stuff over time. It's just a natural way of exploring stuff, reading, figuring out what's happening, and then trying it out. And then some sticks, and then some just falls off. So that's been the approach. No grand approach or any major thought process that this is the road I should travel. It's just exploring stuff, figuring stuff out, and then dropping what does not resonate with me.
So essentially, Rohit, you say that your current style drift can be termed as opportunistic. Is it?
Core remains the value approach, but then I try to look at all other approaches and kind of step back and think of the mindset behind it. So let's say, for example, yeah, go ahead.
Please. Yeah, I think you're answering it already. I wanted to ask, how are you aligning all these things together?
Right. So it's still work in progress. So for example, when I look at momentum, the first thing which comes to my mind, or kind of if I look at it coming from a value investor's vantage point, is that there is so a couple of quick things which kind of are coming to my mind. One is the whole concept of business momentum. So there is definitely some business momentum which is happening. Now it could be business momentum, it could be some kind of behavioral momentum. Again, as I read through the books, I realized a lot of academics trying to dissect it. I kind of just went beyond that. Forget about why it is happening. At least let me understand what is happening. So could see, okay, there is a concept of business momentum, and then there is a behavioral momentum. So again, how does that play when you're investing? And a lot of times, value investors like me will ignore that. Will say, let me just buy a stock which is cheap, and then keep my fingers crossed, and will all work out. But if, for example, there is no momentum behind it, then you could be waiting for a long time. Second was a very simple, formulae. And then one study which kind of really hit me some time back, and I don't remember where I found it, was that someone did some analysis, some professor did some analysis for the last 25 years in India, and found that momentum strategies had outperformed value and everything like 7 or 8 basis points, or maybe not 800 basis points per annum for the last 25 years. So that really hit me. If such a simple strategy is outperforming all the other work which you are doing, pure logic says that economy of effort, right? If you can get so much done. So it kind of then led me to looking at more at quantitative kind of investing and what variables, right? So now the way now I think of some of this is, can I use these quantitative filters to at least filter down stocks, right? In the end, it's all about getting the odds in my favor. Now, again, I may not go with momentum because momentum requires a different mindset, requires a higher churn. You need to know when to get off the train and all that. But at least I need to be aware of what all other investors are thinking when I'm looking at a company. And if I have it in my portfolio and I see it go bonkers in terms of price, at least I should know how the other participants are looking at it. So that kind of helps me inform my buy or sell decision. So again, same thing I have looked at traders. Okay, what is the mindset which traders bring, right? And I think the number one mindset I have found is that traders have an exceptionally good mindset around our risk management. Value investors are like, let's, and again, I know I'm kind of crapping on value investors, and there's a lot of good. So being a kind of a lifelong value investors, I think I get the privilege to kind of criticize it because I still practice it, right? But then there is value in, no pun intended, but there is value in learning about, or at least understanding the mindset. So value investors, for example, traders have a very great mindset around risk management, constantly thinking about risk. I've been in a way guilty of not looking at risk as closely when I'm doing long term. It's always buy and hold and pray and it will all work out. So that's the drift I've been moving in that direction. Again, had a few major failures in my own portfolio in the last 3 years, and that kind of pushed me in that direction. That there is a blind spot. So let me explore the blind spot. Why am I not able to figure some of these things out using the whatever mental models or mindset from a value standpoint? So it's always that if something doesn't make sense, okay, try to figure out why that's not.
So Rohit, I would like to delve a little deeper on this topic if you don't mind, because usually mixing value and momentum is it's easier said than done. Can we bring home the point by probably giving a couple of live examples as to where you've been able to align it successfully, say, buying based on value and riding based on momentum, or whatever your strategy is?
Right. Yep. So the way I used to, I'll step back. The way I used to do it earlier was, let's say I pick a company. So I'll take an example. And again, the usual disclaimers, it used to be part of our advisory. And hopefully whoever is listening to it, understands that this is just for discussion purposes.
Yeah.
Right. Sure. So IEX last year, IEX used to be. It's a great company. It's a power exchange. Hopefully all listeners know about it. But it's a power exchange, one of the number one power exchanges in India. So this was a company which again, my way of looking for ideas is not to just run filters, is to just look around something. Maybe you would even tweet in your Twitter, or anybody tweets about any company, I look at it. So I looked at it, and at that point of time, the company was maybe selling at 30-40 times earning or something like that, but had a lot of business momentum behind it. Right, the post-COVID, a lot of industry was coming back, power consumption was rising, and these guys were reporting exceptionally good results because of operating leverage and because of some amount of business momentum. Now, in the past, if I was just looking at it from a value lens, what I would have done is said, this is 50 times earnings, a complete no-no, because it violates some preconceived notion of how much the valuation should be, and I would have ignored it. But this time, at least now what I've started doing is that, okay, there is more than just looking at valuations and making decisions around that. It has its own purpose and its place, but not in this case. So looked at IEX, felt there was business momentum behind it, was doing well. So I started a position for myself and again for my subscribers. Now after that, the stock goes into a different orbit. It just took off in more than like in a few weeks time itself. And again, Manish, I follow you on Twitter and keep looking at what you guys talk about momentum. And then when I start looking all around, I know of a few other folks who do momentum, and it started appearing in the momentum portfolios. So as it started appearing, the stock started taking off. It went from 50, 60, and at one point I think it hit some maybe 100 times earnings or some very crazy valuations at the peak. So in the past, what would I have done is I would have gotten nervous, and I have gotten nervous very quickly, and I would jump off saying, okay, this is at the higher threshold of valuation, just get off. This time I said, let me think about it both from a momentum and a trader's mindset. Again, I don't use stop losses, but at least mentally, I need to start thinking in terms of stop losses. Start thinking in that, okay, at what point should I get off? So instead of maybe looking at it once a week, month, or year or something like that, this then got into a very kind of a close watch kind of a situation. And then, as traders say, right, it went into a climactic blow off, right? It just took off. And at that point, I still remember some of the books which I've read is that at some point, all the news will be great. Everybody will be just completely thrilled. There's, you would always see everything great ahead. So I did a reverse kind of a DCF, which is again what value investors do, and did some reverse calculation. I realized that market is now, if you look at it from a fundamental standpoint, the market seems to be valuing this company for like 2030 or 2035 or some godforsaken horizon. So at that time, I felt now this is completely in momentum, and the risk reward ratio has become extremely it's not favorable. So at that point of time, I started exiting. So in the past, I would have never looked at the company A, and I would have never gone ahead with it. But now, at the beginning, it was on the threshold of good company at a slightly higher valuation with a time horizon of, let's say, it will work out in 2 to 3 years. But then momentum gives you that pop. It suddenly took off, and at that point of time, just hold on, knowing that it's now not under the control of value investors. Maybe it's the momentum guys who are running with it, and nothing good, nothing bad or good about any of these things, right? It is the way it is. So just stuck on with it, and luckily this was one of those ones where I used momentum on the plus side. In a reverse case, I've spoken about this on a different forum, but another position we held was Sequent, and roughly around the same time, but I ignored this. It took off in the same way, and I again got stuck in the narrative. And then as the numbers turned, the stock crashed hard. So yeah, makes a lot of sense to have these viewpoints so that you know what is influencing the stock at different stages.
Rohit, let me try to give a different structure or framework to what you just said. Because what you just said sounds to me not momentum or
Right.
use of momentum, but
Right.
it sounds more that you are comfortable with the business, might not be comfortable with the valuation front, but you are comfortable with the business. So that is the first standpoint. You're not chasing any stock which is moving. You're saying, okay, business wise, I'm comfortable. That is your starting point.
Right.
And then you're saying, okay, let me not get bogged down too much with the valuation number. If it is not crazy, but if it's in the
Correct.
reasonable range. But since I can't define reasonable,
Correct.
I don't want to have very stringent parameters, which
Right.
sounds very similar to what majority of people who talk about quality premiums, and there is no good
Right.
quality
Right.
premium number, and you can, if you buy a great business, you will always end up making money. uh,
Right.
that part of thinking is looking more towards in that IEX story, at least, which I could see. So are you saying that if the business momentum would not have been continuing, but the price momentum would have continued, you would have still kept your position on? Is that, am I reading that correctly? Because then you are playing momentum also parallelly.
I'll kind of break it down in this way. Earlier, I had just only vaguely heard about momentum. I had not even read about it. I did not even try to understand it well enough. So the first step was, what is momentum all about? Understand how momentum investors operate. Read a few books about it. So at least that was the first thing. At least be aware of the rest of the universe of how things operate. So that was one part of it. Second is, again, in this scenario, the stock already was beyond my normal range of comfort. But as you were saying, right, it was on that higher end where it is getting into that kind of momentum. Now, in the past, what would have happened is that as soon as it hits a certain upper range, I would get off the train, because I did not understand. It was a blind spot completely. I would not understand momentum at all, and trading was a quote unquote a bad word for me, which is a wrong way of looking at it. Hopefully, smarter later than never, right? So and then at a certain point of time, I realized, okay, this stock is now not a value stock, it's a momentum stock. And how do typically, again, you'll have to pardon me if I don't get the specifics right, but how does momentum operate, right? It would be, let's say there's a fade beyond, let's say, 9 months duration, right? If you want to hold a momentum stock, you don't want the best window is, I think, look back periods are, let's say, 15 months. So the best period is, let's say, 6 to 15 months or something like that. So kind of looked at that mindset and said, if it's moving into that momentum phase, let me just hold on it. And at the end of the day, you're making money whether you make it through momentum, value, whatever it is, right? It's not like we're doing some major surgery or something. So at that point of time, it's just a matter of changing my thought process around the company, saying, okay, this is not about the business fundamentals, because all this happened within like 3 to 6 months. The fundamentals did not change as much during that period. It was doing well, continued to do well, and still doing fine. Just a few, let's say, quarters of base effect, because obviously this is mid 2021. So the base effect was coming in, right? If you compare it with 1 year back, the numbers were much better because 2020 was the lockdown period. So numbers were good, but it got into this whole momentum flow. And using that lens, at least I was able to hold it for, let's say, a couple of more months and exit at the right time. And then I ignored that in Sequent. See, that's the other thing. Sequent went into that mode, and I kept thinking about it. I'm thinking from a 3 to 5 year standpoint. And what I did not realize is that once it moves into momentum, a small pin can really prick the balloon, right? So if you don't get off that particular stock in time, then you're going to pay heavily for it. And that's what I did over there. So it's not using I don't use momentum to filter ideas out, because trying to blend the two, it will not work either ways. If you get into a momentum stock at a late stage and say, okay, I'm going to hold this for now 3 years, then you're going to shoot yourself in the foot. But it's being aware at a certain stage, okay, what flavor it has moved into, and can you squeeze a little more juice out of the whole thing. So that's the
I
story.
got that part, but just one clarity on the last part you mentioned. Sorry, I missed that. I think you said you moved out of your position when the momentum turned against you. The business was doing fine, that you said.
So at the last stage, I kind of switched my hat, saying, now this is in momentum. I don't use any formulaic way of exiting
Sure.
stuff out, which you should do if
Sure.
you want to get onto the momentum board. So at that point of time, again, this may sound blasphemy for a lot of blue-blooded value investors, but I kind of switched my thinking into a trader's mindset. At that parabolic stage, forget about momentum and forget about value. This is now a trader's stock. And typically at the late stage, if there's a blow off, what should you do? Start taking your money off. So I said, now forget about it being a momentum stock and all that other stuff. It's now in that parabolic, the valuations are through the roof. Nobody's looking at valuations, and everything is all bright and sunny, and it's all positive news. So time to start getting off the train, and that's what I did. Now again, it looks all nice in hindsight. For who knows, right? Beyond that, it could have doubled over there also. But at a certain point, you have to realize, you as in, I had to make a call that enough is enough. If it is selling at 100 times speed, it is at such a valuation. I can't sleep at night well. So just exited at that time. So it's just changing hats of how I'm looking at that idea at that point of time.
In this particular example, it's not just blasphemous for the value guys, it's probably blasphemous for the momentum guys as well. You kind of got the best of both worlds, because ideally a momentum guy would probably be willing to give away, let's say 30% from the top, because they sell while the stock's coming on its way down and never sell into strength. So you, in that sense, got a best of both worlds.
What I would say is, if you bring another variable, which is, again, I just keep thinking about these different threads or ways of investing and try to see, okay, what do they bring to the table? And the thing which I would say on momentum is that it is, again, you'll have to correct me here if I am getting some part wrong, but if you're running it, let's say through an algorithm or a formula, and all that you have to do is, let's say, spend a few hours, I think, I don't know if I'm getting the term right, non-discretionary, discretionary, whatever, automated, right? If I spend 3 hours and I get this return, which is 10% over and above the index, what I'm doing is pulling charts out, looking at this, looking at that. I mean, there is a lot of value to time, right? So in the end, if I get all of that at 1/10 the time, let's say if I turn the clock back completely 25 years back, and if I had a very different temperament, again, it comes down to temperament also. But if I had a very different temperament and I was just purely looking at it from making money, and I realized doing momentum, doing this 3 hours a week or something, some automated system gives me a slight edge of 2 to 3% over the index, I would happily take it. It's not a badge, right? That I'm not trying to be a Buffett or anything, right? Who will make $1 billion out of it. In the end, it's like, okay, you got a little bit edge, but I spent a much lesser amount of time. So if I come back from a time standpoint, one of the most efficient ways of doing it would be momentum or quant versus all this mumbo jumbo, right? So again, it's some people, a lot of us, including me, do it because we have fun in it, right? It's not, I'm not trying to maximize the efficiency of it. So maybe that's the counterpoint I would say.
Rohit, let's do one. I had few more questions on the things you just said, but instead of asking them right now, I'll probably give more structure to our conversation now from the perspective of a new listener or a beginner or somebody who is trying to learn to the processes, right? So
right.
Let's divide the whole, everything in investing ultimately is about buying and selling and allocation and
right.
creating a portfolio, and you run a portfolio advisory. So all those decisions have to be kept in the context of the portfolio itself.
Absolutely.
Right. So let's first take the first aspect of your investing, which is the buy sell engine. Mm-hmm. Let's do the buys first. How do you screen for your companies? What are you looking for in the ideas you are investing into? So are you, whatever your criterias are, and when you're looking for those criterias, what things you give more weightage to and less weightage to? Because there's always a prioritization of the checklist one has to do in the own mind. So let's start with that first.
Right. Again, this has evolved over time. Maybe 20 years back, simple screens, simple formulas would work. I would run a very simple screen. Again, not automated screens, but I would run a very simple screen saying ROC greater than this and PE less than this, and so on and so forth. And a Marico and a Pidlite and an Asian Paints would just pop out, and I would be scratching my head thinking. And by the way, I used to work in Asian Paints at one point. Had a very close friend in Marico. So I would be scratching my head, is that why is this company selling at 15? So that was a different era, obviously. As times change, you have to adapt to that. Now there is anybody can write a filter in like a minute or even less than a minute, and all of those ideas will pop out. So I stopped using screens maybe 8 to 10 years back. Again, same thing. After a certain point, if you looked at decent companies, looked at reasonable valuations, what I would usually find is anything cheap had some problems in it, and it would usually be a value trap. If I was looking at a good company, then the valuations used to be, and I think it's natural, right? It's this normal competitive sense in a market, and no use complaining about it. So I moved more into an ad hoc kind of an approach now. I would multiple filters, right? One is, let's say I'm looking at a particular sector. So let's say I would be tracking the auto sector through its own index, or I would be tracking the IT sector or anything of that sort. So I would keep looking at the sector, and as I read through the reports and some of that stuff, I'll start looking at some of the companies. Second would be, a lot of it is just exploring around, just reading far and wide. I would be listening to some podcast, watching some video, and some company would come up. And one of the more important filters I use is, there's a lot of content which is now published by pretty hardworking investors, who do a very good job at filtering the companies out. So they would put a video out saying, these are my top 10 ideas or something. People will talk about companies on Twitter. And the first thing which I will do is, I will pull up that particular stock and maybe use the first 10-15 minutes, not for a selection, but from a rejection standpoint. Does this company make sense? Now, again, earlier it used to be a far more quantitative way of looking at it. Company is so much valuation, so let me not look at it. But now I've widened that window quite a bit, for the simple reason, I think the benefit of reading some of the academic research, that the next 2 to 3 years of returns are anyway not correlated with valuations. So when I read that, I realized, okay, why should I put a filter of 25 and 30 when it is anyway not going to matter? So again, it should not be crazy expensive. Like if it sells at 100 times earnings, I just cannot get confidence in those companies. I will not be able to sleep well. So I no matter how good the business is, I kind of tend. But beyond that, everything is fair game. So from there, the analysis is more about rejection than selection. Keep looking at the company, drill down. So look at the numbers. It takes not more than 5 to 10 minutes. You can go to any of these top. I use Screener basically. I know I used personally for a long time. Extremely good tool. So I use that. Look at the numbers. Next thing I would do is look at the PPT. Look at the annual report. What I'm trying to do at that point is, I've been guilty of that in the past, of getting lost in the, what do you call it? Lost in the forest instead of the trees instead of the forest. Try to get the big picture on it. Like, what are the 3 or 4 things which really matter for this company? What are those key variables which are driving this position? And can I kind of get a handle on it? If I'm looking, let's say, at a metal company, let's say it's a steel company. One is, obviously, once it has started appearing in all the forums and everything, maybe it's too late. So when I'm looking at that company, if it is, and again, by the way, I've never held a steel company because that's not my area of competence. But if there is a China factor in it, and I cannot figure out what China will do or will not be able to do, and that is going to drive the thesis, then there's no point of looking at it. So I'll do that kind of analysis and try to see what are the main variables. Am I able to figure that part out? And after that, usually what I'll do is, after I've read all of this, I will leave it aside for a few days, because what I've kind of discovered over time is that initially my feelings about a company, or the optimism, or I would be feeling very good about a company, and if I take a decision at that point of time, I'll jump straight into it, start a position, and get myself locked into it. So look at a company, study it, put it aside, get on with something else. Then come back a few days, a week or so later, and one thing which I've found to be a good exercise is to start putting a mind map on it. So take a piece of paper, draw it out. I have my own way of kind of laying it out, put the key variables, and just think and mull over it. And again, not a very scientific approach. Do that, and at some point, again, what I've seen over time is that it, in spite of all the math and the numbers you say, it often it just comes down to a gut feel. And often that gut feel works out. Sometimes it doesn't. I used to have a very elaborate Excel and a spreadsheet and all kinds of checklists, but again, that I think I've realized it's an overkill. And at that point of time, I'll just start a small position. I usually won't take a big position because again, I come down to the same thing that it'll take much longer for me to get really comfortable, understand the risks and everything. So not a very structured process, but that's broadly how I follow. And then if I think there is something missing in the company, I'll put it on my tracking list, and then come back to it once again. Some video would pop up, somebody would make some comment, and that would connect the dots. So it comes down to more around connecting the dots at a later point.
So for the start, you are saying your way of screening the companies have more moved towards from quantitative to some other commonsensical methods. You're saying you're looking at some other smart investors doing their work. You are taking ideas from there and then doing your own study. But you also said something around index. So I just wanted to, put across that point in a more elaborate way. What exactly you meant when you said you're looking at the index? Are you looking at index valuations and saying, okay, this index is now approaching the zone, or what exactly are you doing there?
So again, this is going to be, again, blasphemous for value investors. But you have the whole traders approach of how they look at stocks and how traders look at it. Right? Like, okay, where is I don't look at it at a stock level, but let's say, an index is constantly dropping, right? This again comes back from my prior experience. I bought companies and then long-term buy and hold, and then I've sat on it and waited, for it to turn. It has never turned. So I was constantly thinking, like, if the numbers are right and the valuation, I'll give you an example. Manappuram Finance, I used to hold that. The valuations all seemed great. Numbers were fairly good during the period which I held, and the stock just went nowhere. So it passed all the filters, passed all the checklist, and still, huge amount of opportunity loss. So this came to a point of, I have all these opportunity losses. Timing is sort of a no-no in value, right? But again, it's important, right? You can't just lock your capital for 2 years and hope and pray it all works. So again, started looking at, how do traders do it? How do momentum guys do it? And what I found around traders is that they're looking at, how the charts are moving and moving averages and all that. So what I would look at is, again, not a way to filter stocks out, but way to avoid a sector. So let's say IT is on its way down and it is constantly, the index is hitting, let's say, below 200-day moving average. So forget about, okay, has it dropped from 30 PE to 20? If PE is not correlated, then what's the next way of looking at it? Maybe it's charts. Again, these are all thoughts, I keep changing the way I look at it. But what I found is that if all the stocks are on their way down and the charts are on their way down, then, let me just wait, right? Let me look at that particular sector, read it, understand it, but I don't need to make a decision. I don't need to pull the trigger on it. So I'll wait for it, and I'll wait for all the selling pressure to go away. And then, as traders say, right, the stock is in just a trading zone, right? Okay, then let me get a little more active. And maybe as stocks and at the industry kind of starts settling down and people are losing interest, then towards the later part, start looking at creating a starter position. In the past, I would do my usual, the hero jump, right? Oh, the stock is going down. I'm smarter than everybody. It's getting cheap. Nobody understands it. It's going down. Let me keep averaging up. Then over time, I realized, all this, I'm not Buffett. So, right. So let me not buy stocks which are dropping, because I am definitely missing something and the market is smarter than me. So just nicely watch the sector, watch the companies, and wait for things to settle down, wait for the selling pressures to go off, and then start looking at it when it gets into those trading ranges. So again, this is where whichever way traders approach it, looking at it from that side.
I will come to position building later also, but just to solidify what you just said, are you saying that adding to a dropping stock, or basically positioning up on the first falling stock, is something you have stopped doing
Oh yeah, completely.
currently? Okay,
Yeah,
just to
completely. I
solidify
used to
that.
do
Okay,
that. I
okay,
not as much, because one thing which I always, this phrase which I've always kept in my mind when my position is dropping, and I've seen a lot of people average down, is the first thing to do when you're in a hole is to stop digging. So as soon as my position starts dropping down, I think the one smart thing which maybe I would have done in the last 25 years of my investing is never average down. And I think I
okay,
cannot recommend it enough.
okay,
It's one
understood.
thing for the super investors and all the other people to do it.
But
Even when I had barely anything, I've never averaged down. I'll have a cap saying, okay, my usual positions will be X size, and once it hits that, that's it. No, absolutely no averaging down. And then
okay,
a few more experiences in the recent past, and then what I've seen happen in the last 2 years in the US, in India, in other places where all these high flyers, the SaaS companies and the technology stocks went into a nosedive. It's just more and more. It has just kind of firmed up my view that absolutely no. Now again, I will not die a billionaire, but then I don't also want to die completely poor, or become poor in the interim. So it's again a risk management.
Hi, friends. I hope you're enjoying this episode so far. I just want to take a minute to thank the sponsor for this episode. Now, Stoic Talks was built on a premise of actionable insights, and detailed questioning without constraints is the only way to get that. And for that, you need independence. Now, when you're looking for somebody to partner with, you're not looking for somebody just who share your ethos, but who also will promote this independence of asking fearless questions without any hesitations. So when we were looking for someone like that, the obvious choice for us was DSP Mutual Fund, as I have known their team. I have worked with their team for a long period of time. Now, if you're an investor, there's a high chance that you are already familiar with at least some, if not all, of the excellent research that they put in public domain. There are reports like Netra on the macro parameters. Then there is a report called the transcript, which gives important snippet from the con call transcripts and discusses them. Then the annual report Nectar, the Navigator, and many such excellent reports, which I enjoy reading and is enjoyed by many practitioners in the investing community. So we are extremely happy to be working with such a team. They completely agree with our vision for Stoic Talks, and I wholeheartedly want to thank them for supporting this episode. If you aren't already, I would highly recommend you to follow them on Twitter with their Twitter ID as @DSPMF. And you can also follow them on their YouTube channel where they put a lot of insightful videos regularly. Thanks and enjoy listening to this show.
So just again solidifying for the listeners, you're saying that when the index point you mentioned, that is not really for the selection part. That
It's
only
rejection.
Yeah, it's rejection, and also it's also in some cases a falling sector might entice you to look at the sector, but you're not going to buy it at that point in time. So it might
Absolutely.
act as a initiation point, so to speak, for your
Yeah.
study
Correct.
from a sector perspective. And
Correct.
other companies you're borrowing ideas also from other smart investors, and I'm pretty
Right.
sure after so many years you know a lot about a lot of companies, at least a bit about a lot of companies.
Correct.
So
Correct.
some
Correct.
ideas
That
flows
helps.
from there, yeah, and so
Correct.
on and
Correct.
so forth.
Even
So that bit,
companies which I've held, I will come back to the companies which I've held in the past, and then it pops up in some screen. So and then again, I have a continuous running list of companies which I'm looking and tracking. Any point of time would be 40, 50 companies looking at it. And I have a like a wish list, which is like the bluest of the blue chips, which I've kept them on the side and said, if the world goes to hell for a short period of time, if the world doesn't end after that, like a COVID-20 or 2008, and then these are the companies I would love to own. So just making this up, let's say a Titan, right?
okay,
If
I
the
have a
world
lot of
ends,
questions on that wish list, but
I'm sorry.
I'm saying I have a lot of questions on those wish list.
Sure, sure.
I'll come to that. But let me also bring one more point to this selection part. So when you have given all these are only your screening criterias, right? Let's also now look at your evaluation criteria. Now, I remember, I think the last time we met was somewhere 8 years back.
Right.
When we met, and we had discussion around checklists and forensics, and we had a lot of
Right.
discussion around those points. And we discussed a lot of things which were there on your checklist, and it was a huge list, if I remember
Correct.
correctly. From
Yeah.
I think 18-20 points on your, even just the psychological checklist had around 18-20 points.
Oh
The
yeah, big one.
behavioral checklist, and then a lot of business checklists. You passingly mentioned that that was an overkill, right? So
Yep.
can you take us through the evolution of what used to be on your checklist, and what parts you realized that were overkill, and which you realized were actually a good points to keep, and you still keep them, or you don't keep
Right.
them at all, whatever your current process is in terms of evaluation?
The way the checklist got built is that I started. This is an era where you would not get as much data, so you have to painstakingly pull an annual report, read through it, and then I would put those numbers into a spreadsheet. And then every time I would read a book or I would come across some concept or something, I would plug it into that spreadsheet. And then I started this, let's say in early 2000. Over the next 15 years, it just kept growing and growing, and different tabs. And I know a few friends who make fun of this spreadsheet, saying you have this 60 tab Excel. So it just kept growing. What kind of took me to a point where I thought it was an overkill is because after I had done all this work, and then I still realized that the success. So again, I'm a very meticulous record keeper of my own investments, what is working, what is not working, what is the success rate, what is the failure rate. When I correlated, I looked at the ideas which had failed, and then I looked at my process. I realized that doing all of this had not improved the success rate. So that was the first trigger, right? That this is not. So the second thing which I then came to is, okay, what are the parts which do I really need to go through all of them? Now there are certain. If I break down the spreadsheet, it was more, let's say, taking down all the quantitative numbers. That was one aspect of it. Second is, let's say, the behavioral aspects. The third is the business model, and fourth would be the DCF, and fifth, let's say, would be the accounting piece of it. So the first thing which went out of the window was the valuation piece. Now I would do this whole elaborate spreadsheet about DCF and this multiple and that multiple and all that. I just threw it out because it was not adding value. You can put whatever numbers you want and you can make it all work out. So I kind of threw that away right away and start thinking in terms of more like ranges and probabilities. Instead of agonizing over 30 times P and 28 times P, just look at ranges and see where it is. So that part went out right away. The second part, which I kind of think through it, but I would not sit and type into it, is the behavioral piece. No matter how many times I wrote it down, when the time came, it's very tough, just to look at that checklist and behave in a different manner. So took some of that behavioral stuff out. What I have added more is around the management piece, which is more around that it has now become a negative checklist. Are there any red flags which I should be looking at? And I will check it against those red flags. So those have not gone away. What I've emphasized further is how well is the management executing. So that's the other thing which I realized over time, that the difference, once you get the basic idea of the business, the industry, fine, it all comes down to how the management is executing. And the way to the best way to do that is to look at what have they pull out the last 8 to 10 years of annual report, look at what they have said and what they have finally followed through. So that part I continue to do it. I would look at what they had, let's say, committed in 2008 or 2010 or 12, and then follow through. The process has been, I still use it. I don't meticulously update every tab and everything. It's more kind of just quickly run through it. And again, it comes to the same point, that if you're going to spend so much time on this spreadsheet, is the ROI on that time good enough? So there are aspects to it. Some aspects I've just dropped it. And again, some of it becomes second nature also. So you don't have to keep typing all of that again and again into it.
Sure.
But end of the day, where I've tried to come down to is that in a buying process, how quickly can I zone into the key variables of that business? And if I'm, let's say, looking at a bank, instead of updating 20 tabs, the first thing I'm going to look at is, what is their cost of fund? Are they able to keep a low cost of fund in their operations? Second is, how do they think about risk management and growth? Is this a management which is crazy about top line growth? Because if they are, today or tomorrow they will blow the institution up. Because if you try to push beyond a limit, no matter what, you'll do crazy lending and you'll blow it up. And third is obviously around their credit underwriting and everything. So if I can zero down those 3 or 4 variables, then I can drill down instead of wasting my time on all kinds of peripheral issues which may not be important for that business. So that's how it has kind of evolved. Try to get down to the crux of that particular idea more than.
What you're essentially saying is your checklist is now much more prioritized. Instead of giving weightage to all the points.
Correct.
You are now looking at few 5, 6 major checklist points which are very important.
How quickly
for you.
can I come to those?
Yeah, and I think those will also have some variations vis-a-vis the business model and vis-a-vis the kind of companies you're looking at.
Right.
I mean, I can fully relate to that whole process of, with years, your checklist becomes, I think I have told this to many people, that the difference between a novice investor and a experienced investor is that for novice investor, all the checklist points are equal. It's not a question of number of points. I think everybody can now get a hold of 100 checklist points to have. It's just a matter of you learn to prioritize pertaining to that particular company and business. Okay. So,
Puneet, how big is your checklist?
You have seen my checklist, dude. You remember, right?
Yeah, this is the reason I'm asking.
Yeah. So, I mean, my spreadsheets are equally big, very, very big number. But then my working is very... my reason for having that is that I have decided to convert a lot of qualitative questions which people generally have and try to see more of those coming from the numbers themselves. I mean, so like Rohit, you mentioned, right? I want to see the execution of the management. So I try to build elaborate models around capital allocations using the cash flow statement and try to get a lot of answers from there only. So those analytical sheets are more...
How do you do that?
Yeah. So how do I do it is
like an example, like when you said, right?
Yeah. So eventually every cash flow line item can be categorized. I mean, it's ultimately a source of fund or an application of fund not from accrual based, but a complete cash basis.
Right.
Yeah. So when you do that, you differentiate between one line item as either source or application, because it is negative. If it's negative, it is going to be a source, and otherwise it's application. Vice versa. So when you do that, you are able to bifurcate the sources and application year on year and on cumulative basis. So what I do is, so one line item can act as a source or as an application depending on your time frame. Right. Correct. So in many cases, equity can become a source, but if you have given more dividends than what you have raised, it will become more like an application of fund kind of a model. So I divide those, and I can share that with you offline also. And I see it over time, over multiple time frames. I will see 3 years, 3 years, 3 years, 3 years. Then I will see 6 years and 6 years together. Then I will see over the 12 years journey and individual journeys also. And there's a model which is helping me do that. So earlier it was more towards, the same analytical stuff was less, too much of checklist points. But now my spreadsheets have evolved more towards analytical points. But this podcast is not about me. So Manish, I will stop now. It's more about Rohit's process. So let's stick to that.
No, it's great to, I mean, I would also, anyway, I think we should connect and we should talk about it, because one of my, I would not say obsessions, but one of my areas of focus is how do you, and I keep bringing this, how do you improve amount of time which you spend? There is obviously a certain minimum amount of time which you have to spend to analyze an idea, but how do you kind of, I think in an era where we have the likes of Mr. Manish and others who have automated systems, right? And these automated systems do extremely well, and they require much less amount of time. We have to adapt to that. You can you can take a very artisanal approach of analyzing every annual report, but then you have to concentrate more, because obviously you're going to only look at a handful of companies, and then I'm very uncomfortable with being over concentrated. So with time being a limit, how do you bring all these, automated and quantitative? So that's why I was more interested. Maybe we should talk later.
The more you try to bring it from numbers, now it gives it's that prioritization becomes very easier when you focus it on those things. So all the key qualitative questions, be it around pricing, be it around seasonality of the business, cyclicality of the business, most of those now I answer using my analytical models. So that is the shift I have made from last. I mean, when we met last, and in that last 8-10 odd years, that has been my shift. But again, not about me today. We'll focus on your process. We'll get in touch again later, maybe.
That. Yep.
Yeah, sure. So okay, so now I have understood your buying, or at least not buying, the screening process. And a bit about your analysis process, right? Analytical work which you're doing it regarding your checklist. Broadly, you have mentioned it in your other interviews also. I was seeing that some part of your checklist are touched here and there. Let's now take it to the zero down towards buying. So what now finally makes into your list? Because eventually you're also doing portfolio management. You're doing portfolio advisory. Not every stock will make into the list, right? Even if you like it. So what is that cutoff criteria? Actually, sorry, Rohit, let me do one thing. I just had one question around your process also. Let me ask that right now. Okay. So one thing which you mentioned and which I want to ask around that point of evaluation is that your management checklist has evolved with a bit more negative aspects of, of what to avoid, right? Not only management, but give me your absolute no-nos, which will kill your idea for you in 15-20 minutes. You will that if you find that point, you're just not going to touch that company. Let me just have those few negative things you look at.
Usually, and I will not go into specific names, but usually I've avoided companies which their source of success is their political power. Like the only reason why they are so successful in that area and they're making these super profits is because they have the right connections. Because that's and it's not a moral argument or anything. I don't get into outside of maybe investing in a gutka company or a cigarette company. I don't get into moral arguments over here. It's my morals may be different from somebody else's, but anyway, right? So it's not a moral argument I try to make. My concern is that when you get into that model, if a management's or the source of their advantage or competitive advantage is the political linkages they have, that can kind of evaporate if the winds change, right? So I kind of usually avoid that. That is first. Second is, in other cases, it's what I've kind of learned over time is you have to be comfortable with shades of gray. I have all these checklists where I would say, I'm checking all the points, and as I look back on the numbers in terms of the results, I've realized that you always have to think in terms of context and how much you're ready to let go. I think with age you realize that all these things you try to, whether it is management, friends, family, if you try to be too specific about this is right and this is wrong, obviously you don't want to buy into a company where the management, the leadership has been convicted of murder and he's in jail or something. Those are extreme cases that immediately drop off. But outside of that, it is all a composite picture. It's earlier it would be is the management overreaching, right? Are they overcompensating? Obviously that will be an irritant for me, but now I would say that's fine if they are creating value and if they're overcompensating themselves, I'll live with it. I've used the analogy of riding a tiger with my subscribers when I've written about it, that you're on a tiger and this is a risky position. Think accordingly. If things go bad, the stock could suddenly collapse, and especially if every time when you have these market failures, these kind of stocks collapse hard. So, but outside of that, it's not there are very few, but again, if more than one start popping up, then definitely. So let's say politically connected, sensitive sector, and then there are too many related party transactions. They have all kinds of subsidiaries and all kinds of funny stuff going on. At the same time, management is getting overcompensated. If too many such pointers come up, and if I see more than 2 or 3, then the threshold keeps dropping, and at that point, I'll say, let's move on to something else. So it's not one single criteria, but I would put 3 or 4 criteria together, and if it happens, it's again, which is where this whole execution thing has been. It has gained more and more prominence. What my personal experience has been, a little bit of want of a better word, a little bit of a management which is not pristine but which executes well is still, again, no moral arguments, right? You're not trying to make friends, or you're not trying to become some partner with them in that sense, but the market seems to be more tolerant around it. Versus if your execution sucks, you could be the best of the management, and you could be doing everything very ethically. The market will not care about it. And this is where I think, again, momentum and quant investing has a major, I would say, advantage over value, right? They don't care whether what you think about the management. If those few factors are working out, okay, let's go ahead and invest in it. But if it makes my stomach churn, I will not invest in it.
All right. So now we have got a picture on your screening methodology, your evaluation methodology. Now let's go to the selection part. Eventually, something will make into a portfolio, and something will not.
Right.
So what is your buying thresholds or criterias? I now understand that valuation has now reduced in terms of importance. It might still be there, but it has reduced in terms of importance.
It's so what filter.
Makes to your final list? Yeah.
Value should not be a headwind. That's all I look at. It should not be extreme that the multiple compression will cause returns to drop. So one of the other things I'm a big proponent of diversification, not just in number of stocks. I would try to think what are the key variables driving that company or industry. So let's say if I'm looking at a plywood company and a real estate company, and both are correlated to the real estate cycle, then I kind of lump them to that bucket. So my thought process will be, is my diversification increasing, or is my diversification going down? And I would prefer to have companies which are spread across sectors instead of having companies which are driven by the same variables, if you may. And again, it's not a very hard defined formula. I have to sit and think through it and see, okay, what are the variables which are driving all these different companies together. Some variables you cannot diversify away. Again, if it's everything is India based, and if India has trouble, then but are these all export companies or import companies? So that's one kind of criteria. So if I already have, let's say, just making this up, if I already have, let's say, 3 financial services company, one has to go out for the other to come in. That will be the first criteria. Second is, ideally, I would want a new company to enter into the and I usually try to keep 18 to 20 stocks in the portfolio. So I will look at, okay, what is my weakest, this usual 101, what is the weakest position, take that out, replace that. And usually we'll start with a smallish position. So I rarely go above 5 to 7% because that is the threshold at which I'm comfortable. So I'll start with a small position, let's say 2-3%. Start a kind of the first thing it will do is I will start just like a toehold. I will just create a very tiny position. It will be like a 0.5% or a 1%, and start following the company. Because what I've realized is that tracking list and all that is fine, but once you put money in a stock, it changes your approach. When you're making money or losing money, your attention to that company goes up. So it just I've seen my own and other people's psychology also, again, within a certain limit. So I'll put a little bit of money and then start tracking
you do in your advisory portfolio also?
No. I will not start in that way. I don't want all the subscribers to pay for my experiments. So I will. Okay. I'll do it in my personal portfolios.
Eventually, it will flow to your advisory portfolios.
Okay, right, and I declare it. I'll tell the subscribers that these are the 10 small positions which I'm tracking. it's not advice, and I'm not asking you to buy it or nothing of that. So I'm just tracking them,
Okay.
and I'll track them and I'll watch it. And so quite a few will just fall off. And then if I get comfortable, and if the management, and that getting comfortable can sometimes vary 1 quarter, 2 quarters. Sometimes I will not get comfortable after 3 quarters, and I'll just drop it off. Once I get comfortable, then it will be a graded increase. Sometimes it goes straight from, let's say, half a position to 1 position, because some variable which I was tracking, or I was able to connect some dots, and then results come in and it just clicks, and then I'll just take it to a 5% position, maybe sometimes a little bit more than that. If not, then it will get stuck in that size for 3, 6 months, 12 months, and at a certain point I will realize that this stock is not going anywhere, the company is not going anywhere, and it will get anyway washed out when the next idea comes in. So it's a graded generally. I usually don't scale into the full position right away.
And on this topic of position sizing, Rohit, how big do you allow it to go?
In the past, I've allowed it to go more than 15%, and then I've burnt my fingers on that. So usually not more than 10 now. Again,
so after 10
it's all
at market value, you will start scaling it down. Is that what you're saying?
Right. I will. It again. I've different. I think when we talk about selling, we can talk more. It's different criteria. One of the criteria in my head is that once it is above 10%, this company is in a special kind of a bucket where it needs to be tracked more closely. And if things are not working, let me start. And again, have a sort of a thumb rules in my head. Let's say if it's a large position, and a bunch of the other things which we were talking, right? It's a large position, valuation seems to be extreme, a lot of momentum around it. Okay, let's start taking it off. It's a large position, extreme valuations. Let's kind of take it. So it's a bunch of things I'll put together and say it's all coming down to basically risk. Is this large position adding to risk? So, but yeah, above 10%, it gets into that. Below that, between 5 and 10, it's in that yellow kind of a zone that, okay, I may take it down, may take it up. Below, if it's let's say a 3% position, then I will give it far more leeway, because it's not going to move the portfolio needle that much, right? If I get it wrong, I'll lose maybe 0.5% on my portfolio. If it does extremely well, also it will not.
We'll come to the selling part again, but let's close this particular loop here only, in case we miss it later. So 10%, let's say just hypothetical, right? So a position became, maybe you at cost it was 5% or 6%. This position did much better than other positions, and it became 10%, which is your mental threshold. Again, it's not written, you're not quantitatively applying this, but it's a mental threshold for you.
Right.
So it reaches that 10% stage. You are now more closely monitoring it.
Right.
Would you go out of or trim your position based on opportunities also? Or let's say, I mean, if you're in a market where opportunities are not really that much, in a crazy kind of a market, you would say, dude, if I take out the money, I don't have an option, I'll have to move to cash, right? And moving to cash might not be a great way. I want to stay in the stock just because my alternate is cash. Or do you have a view on cash position raising at that point in time? So I want to, basically this question also takes into consideration your thought about cash as a part of your allocation. Yeah.
I usually don't think of cash as a quantitative, but it's more a kind of a balancing equation, if you may, right? Putting your formula together, and whatever is the net, it kind of balances the whole thing out. So again, I have been personally, I would say, over cautious all my investing life, to the point of being paranoid. I just don't want to blow up. So I've usually held more cash than I should have, even looking back. It's ranged between 5 to 20%, sometimes above that. But I will not hesitate to come out of a position and put into cash, whether I have or I don't have a position. Again, I'm not putting cash because I have a certain view of the market or certain view of where the economy or all of that will go. It's just that I'm not finding ideas which I want to put in it. But usually, as markets start correcting and more ideas coming up, cash starts going down. As markets get euphoric and I stop running out of ideas, cash goes up. And that will happen even if independent of everything, for me, if a position, I'm getting uncomfortable with it and if it's too big, I'll sell it down and it goes into cash, and that's a different mental bucket. Cash is a different mental bucket. Positions are a different mental bucket. Finding a new idea is a different mental bucket, all independent of each other. But let me put it this way, I'm not afraid of holding cash even if it drags my performance. So be it. And I've told my subscribers also, I invest, my own family's portfolio is in the same way. So if I'm not comfortable with it and my family is not comfortable with it, I will not do it. I will not do it in any other way. And obviously there is a penalty of holding so much cash, but keeps my blood pressure down.
Okay, fair point. But okay, so when was the last time you went into that larger, cash positions? I mean, just to get an idea about how and when it worked out.
This was 2018 time frame, roughly,
Okay.
and then it was in
into
the depths. It was right, and then it was early 2020, like before the COVID. So COVID was a very interesting time, and we could talk a little more at a later point. I started.
Or we can talk now. You can
as
we'll bring it in. You can talk about it now.
Right.
Yeah.
I usually don't try to time, right, because I'm not good at it. But as I started looking at how COVID was developing in late February, just the whole thing around the mental model of compounding, which people keep talking about, right? And what I saw around, I think a lot of investors got this right actually, because they kind of think constantly about compounding, and we could see, right, that infection rates were increasing by, let's say, whatever X percentage or 5% per day. And if you did a very simple extrapolation, you could see that this was going to go parabolic. So I even actually wrote a post and I published it to my subscribers saying, in the next 8 to 10 days, there's going to be a oh shit moment where all these things are going to go through the roof, and governments are going to panic and people are going to panic. And I think a lot of investors kind of caught that. I saw all around me, even my own personal family felt that, my wife felt I was overreacting. And then, you don't argue numbers with your wife, right? So, but at least in my portfolio, that's when I started going into cash. And then obviously I became, very concerned about how this thing was. So that was the only thing when I went into cash, and I didn't exit out quickly out of cash, because again, I kind of underestimated how much liquidity would get pumped and how it would. And again, it all kind of boils down to your own personal experiences around investing, right? The era, the time, your family background. So in the past, all these bear markets would be slow, grinding, would take, like my first bear market was in 2000, actually from 2001-ish to 2002 or 3, and even prior to that, there were no parabolic takeoffs. It was, the market would slide, and then it would meander for months and years together, and you would completely get grinded out, and then slowly the market would recover. So I kind of thought, if that happens, the best of us would lose patience. So I didn't jump in. So that's how my kind of cash remained high. And then slowly, obviously as opportunities kept coming up, I've reduced cash. But usually, it's usually in low double digits often, right? 10-15% is the cash I would generally keep. Goes down only if I find.
Just to close the loop on that point, was the reason of not going into more cash when you saw trouble, creeping into the markets, or possible trouble keeping into the markets? Somewhere at the back of your mind, was it that, okay, 20% is my threshold of maximum cash and I don't want to go more than that?
That is more around. That is more around the same aspect. And again, it's not a very scientific way, but it's that, again, another thumb rule I use is I don't know about what's going to happen. And as a matter of fact, nobody does, but then people think they do, but that's a different point. So if I don't know, what's the best way to do it? 50-50. So I don't want to be out of equities completely, because then getting into it is another story altogether. When do you get in? But at the same time, it all comes down to, I kind of bring it down to a threshold where I can keep my sanity and my rationality intact. Like if I'm fully invested, different people, right? Some people will absolutely want to be 95% invested and will stick to it. Some people are very paranoid, will be a lot in cash. I sit in between. So at that point, I thought, let me bring enough cash, again, from a different vantage standpoint, that I could deploy it at a later point. I'll remain rational when the market is crashing, and the drop is much lesser. So I kind of brought it down to a not a very scientific level, but brought it down to a point where cash was almost 30 to 40% of the portfolio. But there were
Wow.
companies which I felt were good enough, and if and when things survive, these were fundamentally sound companies, and they will. And I did an exercise actually at that point where I looked at each company, and I actually wrote a note and then shared it with my subscribers at a later point, because if I had shared it that time, they would have panicked. Was like, if everything goes to zero, in the sense that the lockdown continues for a year, which of these companies would survive? So I did that for every position, said revenue goes to zero, how will they survive for the next 6 to 9 months? And I did that in 2008 also. So if revenue goes to zero, how much can they reduce reduce costs? How much cash do they have? How much can they borrow? So what's their runway basically of survival? And some companies had a 6 months runway, 9 months, 12 months, like extreme stress test. And then, based on that, if I thought that, this company was a little bit on the edge, keep the position size down or sell it off. So that's how I did. But those are very extreme cases. Most of the times it's a run of the mill recession, like we're talking of now, right? Recession is going to come up and all that. I ignore all of that. That doesn't factor into my cash, this thing. I mean, it's part and parcel of life. So why worry about recessions?
Stoic Talks has been partnered by DSP Mutual Fund, which was an obvious choice for us, having worked with the DSP team earlier and recognizing how they are obsessed with helping investors take better decisions. Some examples of their motivation to help investors do better are visible in their research related work, which they make available for free, including Getting Smarter, Tathya, Report Card, their Invest for Good blog, among others. We thank Team DSP for supporting this episode of Stoic Talks and recommend that you follow them on Twitter at DSPMF. Yeah, Rohit, I'm still not able to get my head around it. Essentially, you were saying that through your analysis, you pretty much predicted a corona crash. I mean, not you don't know how much it will crash, but at least you were able to figure out that this is going to go parabolic. And
the infection. Yep.
Yeah, my point is, why did you just take a 40% cash call? Why not go 100% cash? And if anything, hedge it with some puts. I mean, it's a trader in me thinking if I'm able to foresee that.
Yeah. So again, I did buy some puts again for my personal portfolio, right? But by that time, the volatility, it was. All of this kind of transpired in a matter of days, right? By the time I kind of got clued onto it, a lot of other smart investors had also started cluing onto it. So puts and all of that were not very, were not priced very, we're not attractively priced. So that was one part of it. Second, by the time I started, again, this happened like over a span of 2 weeks or maybe a week or so. And by the time I started exiting, some of the positions which I had were getting into a situation where the market started pricing them for a very extended like a downturn. Like, okay, the market is going to go fut for the next or the economy is going to go completely down for the next 6 to 9 months. So at that point I realized that there is no point in just throwing everything out. Let me and it, in hindsight, even that I actually wrote to my subscribers also. It was like a 50-50 bet. 50-50, market recovers quickly, economies recover quickly, and we are off to the races, which is what happened. Or 50%, everything goes completely haywire. So I said, honestly, I can see where the infection is, but I cannot foresee what happens after the extrapolating the graph and everything was one thing, but saying, okay, this will cause a complete lockdown, and how long the lockdown will continue was a tough call to make. That second order effect, right? And the third order and fourth. So I said, let me take a 50-50 bet, right? Let me bring it down enough, but still remain invested enough that if and when the parabolic, or whatever the recovery happens, I'm still kind of, exposed to it. So again, nothing mathematical, just sheer saying that I don't want to take a view on how things will work out. and taking a completely 50-50 bet. And then post April, when things started recovering, I started putting money in. So that helped. I mean, basically that is what I did.
Okay, I just wanted to know that, I've spoken with a lot of value investors, and 2020 Corona crash has had a paradigm shift in the way they think. Uh, has it impacted you as well? Have you changed your approach post the lessons from this crash?
So let me maybe put the question back. What kind of paradigm shift have you seen with other?
So, without naming names,
Correct.
I know people who are started taking care of the downside risk now, so they know their
Okay.
exit plans. Yeah.
Okay. So in my case, the COVID crisis actually did not change my thought process in that much. For me, things which grab my attention and like really make me question are when my individual stocks go completely haywire. And when I say haywire, it's not 20-30% drop. So I've had maybe over my entire investing lifetime 3 or 4 stocks which have gone down by more than 50-60%. And when that happens, that has that I would spend weeks, months, maybe I very vividly remember all these stocks, right? And then I've done a lot of questioning about my process and about my thinking. And those whenever those things have happened, I've kind of looked at, okay, what went wrong. So that happened more around the 2018 time frame. I had invested in some of the financial services, and these companies, I did all kinds of analysis, poured over their accounts, looked at their loans, did all kinds of stuff and got it completely wrong. Has happened to me in early 2000 when I bought a company called SSI, and that went 97% down or 90% down. But I was very new to it, so I didn't know absolutely anything about what I was doing. So my mindset change around risk management maybe I started putting more focus in the 2018 time frame when I saw certain positions go completely against. And it's more around not that I got the position wrong, it's about, which I get obviously from time to time. It was like I did all the work, followed all the rules which I have put in place in my own case, right? And then in spite of that, got it completely wrong. So then it was not that, what did I do wrong? Like what went wrong from a thought process, thinking. And that is where all this exploration around momentum, around trading, around quant started coming up. Like I clearly saw there was a blind spot in the way, I was approaching all of this stuff. And it made sense to read all of these other approaches, philosophies, and look at what. So by the time 2020 crash came, I definitely started looking at the whole risk management and downside protection. So not 2020, but prior to that.
Got pretty much about your allocation strategies from, deriving from what. So I'll just summarize those points which you've just mentioned.
Right.
Before I do that, do you also have industry limits? Like for stocks, you have mental threshold of around 10%. Yeah.
15. I'll generally keep it around 15%. Again, right. If I have 2 positions, usually it will not go above 15. Again, same thing has come from some of the failures I've had in the portfolio. I allowed it to go. And again, when I say industry, I don't look at it purely from industry. It's also, okay, are there
similar drivers,
common themes which are driving it, right? Yeah. Same value drivers, if you may, right? So yeah, but 15. So again, same thing. Paranoid about not losing money. And I keep telling that to my subscribers. You may not make exceptional money, but that's the price you pay. So with India doing well and things doing well, and I personally always felt you don't have to go crazy after the returns. If you take care of it and you live long enough, the numbers will come.
So you're at any point in time, you're going to have close to around 7 different set of, let's not call them industry, but something where the group is being categorized by some driving points, different set of driving forces, 7 to 8 or whatever be the case, right? So
correct, whatever it.
And you also mentioned that your starting positions are 0.5 to 1% if you're doing your personal portfolio, where you're doing also some testing the waters kind of thing.
Right.
In your advisory portfolio, it starts somewhere between 2 to 3%, and then you scale it up as you get comfortable.
Correct. Correct. Yeah, that's a fairly accurate way of how I manage it.
Okay, so 2 to 3% scale up. Sometimes
5.
at cost level, how much do you go, or 10% is there also? I mean, generally your stocks will be moving
No,
up
at
because of
cost
your.
level, usually 5 max. It will go to 6 or 7, but it has rarely ever gone above that. I'm not just comfortable putting more than that.
Understood.
I don't recall last, maybe once or twice it would have happened, but mostly, it will get capped at 5 to 7. And again, I think with time, markets have become so much efficient. By the time I figure it out, the world has figured out much before me. So the position runs up. Those
Sure.
times used to exist earlier. I'm telling you, 14, 15, you figured it out, and then say you kept
You had
raising
around the
it,
time
and then
to.
markets give you enough time to respond and do it. Now, by the time you kind of figure out 50% of it,
There'll be
markets
5
have become
YouTube videos on it
phenomenally
and
competitive.
50
Oh yeah,
reports on
yeah,
it.
yeah. Oh yeah, yeah. Now it's become a young man. It has always been a young man's game, but the efficiency in Indian markets is mind-boggling. It's
Sure.
what is working today will definitely not work in the next 6 months. So that's the other treadmill we are all on.
Sure. So okay. So then that is the case that you do 2 to 3% and maximum 5 to 7% on your cost basis. And
Right.
because of market, if it goes beyond 10%, you start thinking about the position more seriously.
Correct.
And for sector, you said that a replacement
15,
of a
roughly
company,
15.
15%, and a replacement of an idea happens either because of your position size becoming too large, so you have to think about next idea to replace it with, or
Right.
it's something is more enticing given your current risk profile of the company which is there.
Correct.
Something is a better risk reward in your portfolio. Is that a fair
Right.
summarization of what
Fairly.
how you're managing?
Absolutely. Yep.
Okay. Fair enough. Now let's and I
Nothing
think pretty
fancy.
much that answers selling. Oh, sorry.
I'm saying nothing fancy. Very straightforward 101.
Okay.
101 of portfolio management.
Yeah, and I think one point I missed to summarize, which is you don't do any kind of averaging down anymore. When you are scaling up the position, pretty much the prices will be higher than what you bought them for in the initial phases, or
a
similar
little bit,
range,
5-10% here and there. 5-10% here
similar.
and there. Usual, bouncing around is happening. That's fine. The fundamentals should be improving. If the price is a little bit down, or price is a little bit up, it's okay. But if things start going south, the stock I bought, it's now down 20. Obviously, the first thing which I want to do is I want to exit it. I should be exiting it. But let's say I feel that 2-3 years time frame, the company will do well, and for various reasons, stock is going down. The first thing which I will do is I will not average down. I'll just hold it up to a certain threshold and
the
pull the
reason
plug.
for averaging down because of valuation has been eradicated. I think that will be a much better statement to
I
make.
think I've kind of I've learned over time that the market does get it right far more than we would want to give it credit for. So if I'm left scratching my head saying company is doing okay, but why is the stock dropping? If you can figure out why the stock is dropping, it's the answer is fairly simple. Right? It'll say company is not doing well, numbers are bad, the basic model is broken. So it's a very simple decision. Sell, exit, you're done. It's usually in the cases where I think the numbers are looking good as of now. Everything is checking out, but the stock keeps dropping. I think that's where the dissonance comes in. Now, in the past, I would kind of hold ground and say, you know what? No, I'm smarter. I know better, and all of that. Now, I've learned, school of hard knocks that you give more credence to what the market is telling you. At least pause and wait. Don't jump in. Save your capital. If you turn out to be right, you'll get an opportunity at a later point also. But don't add to it. So that's what I end up. That's the change I've done over time. Not that I've averaged on much. I've rarely done that, but stopped it completely.
Okay. Fair enough. So I think one point which I probably, or maybe 2 points which I think I'm missing in the whole portfolio construction zone, which probably listeners would want to learn from, but also I want to bring your advisory component to picture, right? So since advisory is one of your services, when you're providing portfolio as a advice, you have to think of liquidity of the stocks, because of
Right.
moving hypothetically from a stock by saying okay, sell it out, versus
Right.
position to actually people to sell it out of the position. How do you think
Right.
about liquidity for your advisor, for your clients? And
Right.
okay, second question I will ask separately. You can answer the liquidity part first.
No, I do. For personal portfolio, I would not, but I've put this filter in the last few years. Usually, I would look at we don't manage money directly, so I have to just guess, right? So the number of people who are subscribed into, I'll just assume a certain portfolio size into percentage of that position. So I'll just make some numbers up, right? Let's say 100 people investing 25 lakhs per individual. That is, let's say 0.25 crores. Let's say 25 crores, right? 5% of that is, let's say 1.25 crores. So if it is 1.25 crores, I would look at a stock where at least the daily volumes, can all my subscribers, including me, buy this stock in a day or 2 days of liquidity or exit out of it? So I'll generally think of that, because if all the subscribers, including me, are going to account for a week's liquidity, then we could get stuck. So I would usually, and there are a lot of such companies which do come up, which appear to be attractive. The volumes are very high. Same thing. School of Hard Knocks, right? Bought a stock which had again, that's the other interesting thing, you brought this up, right? At the time of buying, if you end up buying a stock, let's say it's 2,000 crores market cap or 3,000 crores market cap, usually there will be enough volume at that level if it is doing fine and the market cap is that high. Now, if I start averaging down and that 3,000 crore stock then lands up into the 1,000 crore this thing, and now if I say now exit, not only will my subscribers murder me for losing 70% of that money, exit becomes impossible, right? Because you're trying to exit out of a thinly traded stock, which used to be traded fine, but now it has become thinly traded. And on top of that, the market cap is low, and so I'm not even looking at liquidity at that time. I'm assuming, let's say it's a 20% drop, how much liquidity under normal circumstances will be there, and then obviously those companies, I just take them off, because then we'll get stuck and we'll actually create the impact cost. Again, same thing has happened from experience, that you get stuck and becomes very tough to exit. So
fair point. Actually, the reason of asking this question was primarily from the subscriber's point of view. If somebody is looking for portfolio
it's a very
that
valid
becomes
point.
A very important criteria.
Right. Individuals, I used to never bother, but yeah.
The second point is also related pretty much to this point only. How do you manage the dissonance between your portfolio versus an advisory portfolio, given the fact that you have a constant income to put into your portfolio, because you have a job, you're taking surplus cash from there and you're putting it into the portfolio, so you are more doing like a flow based investing, whereas your subscriber might be doing a more lump sum driven investing. They're dedicated, let's say, okay, I want to invest 10 lakh into what Rohit is saying, and that will become like a more lump sum approach. So how do you deal with that thought process when you're thinking about your subscribers versus individuals?
The way I've approached it is that it's more in terms of a percentage allocation, right? So again, this is a question which has come up for a lot of people. Also ask the same thing. I think anybody who gives advisory and does not manage the money directly will always have this question, whether I am doing it for myself or somebody else. And the way I've usually handled for myself and for subscribers when they ask, or anybody who asks this, right, is, let's say you have 100 in your portfolio, and let's say 5% is allocated across 20 positions. Now, usually what I would do is, let's say 100 goes to 120. So one option is you rebalance everything to 5% and allocate all that extra money out into all those positions. I usually will not do that for myself, and the way I've approached it is that whatever I do for my personal portfolio is exactly what gets put in the model portfolio. So if I'm doing something in my personal portfolio, only that goes into the model. So what I would tell subscribers and what I end up doing is, let's not allocate the extra capital out to companies which are not in the buy range. Allocate it out based on the same percentage to the new idea. So let's say a company which was 5% and you added 20, let's say 20 to the portfolio, and now it has become 120, the weightage has dropped, then so be it. It's not optimal, but then instead of 5, now that position has become, let's say 4.5. Now a new position comes in and it's at 3%, it's at a 3% of the new size. So 100 ka you take 3% and you add to that. At a later point, this old position, if it either increases or if I'm going to add more, will add. So it's a little convoluted way, unfortunately, of approaching it. But that's how at least I do it for my own personal portfolio. If new cash comes in, you're not going to proportionally allocate to all companies out just because you want to maintain a certain threshold. It's more around the new ideas which are coming in, but on the new base. So something like
Actually,
that.
that is where I was coming from, that that in itself would lead to the variations between a portfolio sizing in your portfolio versus your client portfolio, because client is not doing SIP kind of a thing in your portfolios, right? He has bought and he's holding that position, but the stock might
Right.
be in your buy range, and just the sheer fact that out of 10 stocks, let's say 5 are in your buy range when your next money comes in, you will be increasing your allocations to those stocks, and your portfolio will become more more heavy on those names. But for your client, for your subscriber, that will not be the case. And eventually, and again, I understand that market to market will be very different, and there is probably no right answer to this. So that's why I'm asking, how do you manage this? But there might be some extreme events like COVID crash, like other places where you get the opportunity, and the scale will obviously 3, 4, 5 names will get much higher allocation. In that
Correct.
case, how do you manage that dissonance, or do you go back and rebalance after a certain point? Just trying to understand around this.
There is rebalancing happening. The way I'm looking at it is there are two variables in this, right? One is the denominator, right? So the portfolio is not run based. So the way we have structured the portfolio is it's a number just to keep the comparison consistent across time horizons. We started in 2011, even before the regulations and everything came out. So we started with a hypothetical number of 10 lakhs. And then the assumption in that model portfolio has been we are not adding cash to it. Because what happens is you add cash to it, and then there is XIRR, and then all kinds of acrobatics I have to do, right? So I just kept it simple. I said, assume a static portfolio, start with 10 lakhs, and we just do. So the point which you were making, right? It's a fixed. There is no inflow and outflow from the portfolio which I'm sharing to my subscribers, but that's not life, right? All of us are kind of have inflow, cash flow coming in. We are putting money in. So what I tell is people to rebase their number based on that number. Like let's say 5% of this is on this particular total size, right? Look at your own personal portfolio and rebase it to that 5%. Again, if ideally you would want to manage it in a slightly different way, but very honestly, I've not found a better, because if you different individuals coming in at different times, right? So let's say you add 20 lakhs and somebody adds 30 lakhs. How do you achieve that consistency of performance, right? For representative
before I ask
purpose,
the
right?
question, I probably
Right.
had an idea that there is no right answer or there is no perfect way to do this. But just a thought around this and how do you manage this is
correct. No, that's a thing. Correct. I've always wrestled with. You have a very good point, and subscribers keep asking me. What I ended up taking a few decisions in the beginning was I want to keep the performance tracking as simple as possible. So start with 100 and don't assume in and out, because that will not. And very simply say the dividends get reinvested into the model portfolio. This is the money I started with. This was invested in these stocks. These got sold. These got bought. This dividend came in. It was reinvested. So then I can truly say that. Otherwise, you can always take these tricks, right? You can say I put extra 50% cash into this model portfolio in 2020 bottom, and then I started buying from there, and nobody will look for better for it. I took all of those equations. I said January 27th, 2011 is when we started. We started with an amount of 100. I'm just putting this, and that's it. There is no time now. If I can put extra cash in my personal portfolio at the bottom of a crash, fantastic. The numbers are better, but no such extra benefit of hindsight or anything for the model portfolio. Portfolio starts at 100 and just remains at that. So basically, just to ensure that there is transparency and consistency of number. That's what we ended up doing. But I think you're right. You can, if you can put extra cash at the bottoms, it obviously should improve. It should be a plus rather than a minus. That's the way I'm thinking, right? Let's say you keep getting these inflows, right? Hold the inflow on the side. That's what I tell my subscribers, and then add to it when we get more aggressive on the model portfolio.
All right. So a lot of part of the processes are pretty much okay, right? We have understood the buying, we have understood evaluation and portfolio management, etc. Selling is pretty much the part of it, and you've probably covered it to some extent, which is you are selling based on your when the scale of the position have gone beyond your limit. But I'm pretty sure you have other reasons to sell. So let's also note them down. So why are the reasons you sell, except for position balancing or any of that reason?
Number one reason is if I'm not able to get the if I got something wrong, right? I mean, I think that's always right. You end up buying something and the original thesis breaks, right? So that obviously is usually the number one criteria. Second is if I've been guilty of this quite a bit. I bought a stock and then I just kept waiting for it to turn, and then that never kind of materialized. So that's the second. So I've kept a threshold of 2 years, that if a position doesn't work out within, let's say, a year and a half to 2 years, let's move on, right? So that's the second reason. So one obviously, or if so one is thesis breaks, second is doesn't work in 2 years, position size. Fourth is the management just keeps coming up with new excuses every time the performance is bad. Now there I have a much now smaller tolerance. I'll wait for 1 quarter, 2 quarters. If I just see new excuses coming every quarter for why the company is not performing, independent of where the stock is, what the price is, I'll just I've kind of dropped that threshold big time, because that has been the reason why I have ended up getting stuck with positions for years at end before the thing turned around. And then but I never sell because I have a view about, okay, this is going to happen to the industry, this is going to not say industry, this is going to happen to the economy, interest rates, market will crash, this that I never do. So it's all individual position specific that I end up doing it.
So in that, majority of the time it's the same thing with the value investors, right? So I'm thesis break is there, position sizing is there, all the reasons which you mentioned.
There's one more thing. Let me add to that. So earlier I would never look at this, but now let's say a company declares its results, and independent of how the results are, let's say the market reaction is very violent. And when I say violent, as in like the stock really gaps down, right? They literally just crashes 20, 15, 20% for whatever reason. That has my attention big time. Earlier I would think, oh, I'm the smart guy, nobody gets it, I'll just hold on to it. I'll be the brave guy and I'll just stick around with it. No. After 20 years of doing this, I realized. And by the way, this has happened. This has increased more now. It used to not happen earlier. You get nostalgic with age on these things, right? The company would declare a bad result and nothing would happen, and then weeks and months will go by, and aram say, you can sit and mull over it, over your tea, coffee, or whatever drink you want. Now, no such luxury now. If things don't work out now, a little bit of a drop and all that is okay. But if the stock really goes bonkers, right? And mind you, it's not in momentum, it's none of that stock, right? But the stock just crashes. That gets my attention. I may not exit, but definitely, I will start thinking hard about it, and sometimes I may even start exiting. So that has changed. Again, that comes from the trader's mindset, if you may.
It's interesting you said that. At this very moment, I am in one of such stocks, which is also, before it fell that much, it was probably my second highest position. Now it has reduced only because of the fall. And I'm pretty much doing the same thing which you're saying. So I can appreciate the point which you're mentioning. But then let me put a bit more, tangibility to the whole concept of thesis not working, right? It's a very common thing we hear from everybody.
Correct. Everybody says that thesis. What else?
I sell out when my thesis is not working. And in the same breath, we also say that we don't know, right?
Correct.
We don't know a lot about lot things. Judgment could be wrong or delayed, and
Mm-hmm.
we can't time things, and all those things are there. And then we
Mm-hmm.
say, I want to judge, my thesis is not working. Let me
Mm-hmm.
let me put you a construct which has happened to me at least sometimes, is that we have decided zero down on the few points I want to look at, right? Which you also mentioned, priority points, which affects the business and the performance of the business. Those points are not really doing the way I expected to, but the price is doing great, right? The price is doing fine. The stock has done really well, despite the thesis not playing out and the thesis not
Mm-hmm.
working out. In that case, you're wrong on your thesis, but you are in momentum. Have you changed your viewpoint there? Are you going to
Oh
ride
yeah,
the
yeah, I've
thing?
changed completely. So one thing which I've and I think this gentleman called Ashwathan Damodaran, I'm sure you would have,
Hmm.
all of you
Yeah,
guys would
yeah,
have heard about it. I
sure.
liked a few posts of his, right? He's an academic, lot into value, and he's made this good point, right? Like he wrote a very long post around it. Like value investors have a chip on their shoulder and they want to do it in this way and that way, and they made a religion out of it. So I kind of completely went 180 on that.
Hmm.
I've come to, like, when I look at the numbers which Mr. Dhawan has posted right on his website, and I look at other momentum investors, I
Hmm.
mean, the results are there to see. Like, why do we have to get religious about it? So if I see this is happening,
Hmm.
the first thing which I will do is, I know my thesis is not working, but and so it has moved from a point where it's no longer a value play. Maybe it's a momentum play. So I'm thinking a different time horizon. Then I'm saying, what, this has become like a trade, and there is nothing wrong about it. But now think of it like a trader, if you may, right?
Yeah.
So think of it like a momentum stock, and don't think of it that you will hold this for 3 years and then this will happen and that happen. Now be ready to exit at a moment's notice. And sometimes
Good
I
point.
will even alert my subscribers. Sometimes it's very tough to, and this is the point where public versus private investors, I think private investors have an advantage because you can keep flip-flopping and you can change your thought process. But when you're doing it for your subscribers, if you bring in all these values, all these points, what they will say is, अरे this guy, भैया आप कर क्या रहे हो? Like, what exactly is going on? For yesterday you said this was a value stock, now you're talking momentum, then you're talking trade. I mean, ये total खिचड़ी है, तो
Yeah,
so,
imagine
but
getting a mail that I bought this for great management quality, great business, great everything, but unfortunately now it's a momentum stock and not
moment,
a
like,
business stock
and
anymore.
Puneet, you would, and Manish, I know, have sometimes put on his Twitter, and we've seen, right, people. This is the other thing which I've seen. People will come up with these huge stories, me included,
Yeah,
right?
yeah,
And then we get stuck in these stories. That, I think, that is
yeah,
the biggest problem when we do fundamental investing, right? We get stuck in all these stories, fantastic
yeah,
management, we'll go till 2050 and all that. And then what happens, we drink our own Kool-Aid, right?
yeah,
We'll get
yeah,
so stuck in the story, then that story may or may not play out. And then what do? Like, there are all these funds in the US, there are some of these funds in India, they sell based on stories, right? And what happens when the story goes bad? Like, you're a technology fund, you are a SaaS fund. Now what happens when the when the SaaS sector goes down? What do
yeah,
you tell your investors? Oops, sorry, the story is no longer. You double down, and that's it. That's the fastest way to
yeah,
to lose money. So I've kind of realized that when the story changes, if you tell subscribers, you tell openly, they get upset. A lot of times people do get upset that, why are you changing your mind? But, I think that's a strength. That's not a weakness. So
yeah.
uh, you're right. So in this case, if the stock is doing well and all that, I know my thesis is broken, but paisa ban raha hai. So, let's stick around for a little while. And when you make money, everybody's happy.
Today in the morning, me and Puneet were having this precise discussion, and we concluded that BAAP, or buy at any price,
Arey.
is actually functional equivalent of momentum investing only. But the only difference is that when their stop hits, they have to narrate a story.
Correct, and it's actually dangerous. No, you're bang on. People talk about Asian paints and all that. Like, "Arey boss, what are you talking of?"
Hmm,
The only reason why I am able to say something is I worked and I saw that company from very close quarters. Fantastic company, but don't say 2050 may this will happen. That is the other danger part, right? Dangerous part of it. You do this BAAP investing, You're doing momentum, but you're not following momentum all the way, right? You're doing the entry part of it. You're not doing the exit part of it. You're going to kill yourself and your investors, because you can't change your story quickly. You'll allow the stock go down 30-40%. The momentum guys have moved on and gone to some other new stock, and you're still stuck holding the bag. So I'm saying I empathize with public investors who do it, because story sells, right? If you muddle your story, it will not sell. So in that sense, it's not that people are evil or anything, but how are you going to gather assets? Like, I mean, I know I do it on the side. We have not chased assets or anything of that sort. But if you're into the story business, you can't change it so quickly. We have seen that happen with these various ETFs in the US, right? Story change. So, but go ahead. Sorry, Puneet. Yeah.
So there is, I think, a cognitive dissonance element along this, right? So in some cases, and many value investors, they tend to say, in the same breath, you will hear two contradictory statements, which is thesis wrong and market is usually right, and I exit when thesis goes wrong, and in the same wisdom, somebody at some place will give that we should listen to the market because market is a collective wisdom of a lot of wise investors. And in some cases, what I have seen is that my thesis. So most of the time, value investors are betting on this very simple thing that the thesis is right, and eventually the price and value will converge to some extent. My market is, even if market is judging right the business, then you're talking about valuation, continuation of that journey and everything else. So it's not always market wrong. You're also betting on continuation of the business momentum. But on some cases, when especially the point is thesis right and market wrong element, often it has happened that the price has moved much before the thesis points which we are thinking of actually materialized, right? And that is precisely where when you enter and price moves and your thesis is not moving out of the position is actually a very stupid, it's a very weird position to be in. I mean, this is where the learning that market has a huge tendency of being right is where you should think of that, okay, maybe the market is looking at those trigger changes much before they actually play on the ground. And maybe I'm still right and I should still hold on to the position. So not only momentum ho gaya, I'm just saying that the whole point is that maybe the trigger will come later. So why sell out?
Technical analysis. Yeah, technical. So I know what, I can almost see and hear the gears churning, because I've been thinking on the same lines for the last maybe 3 years now. And I saw it happen with some of my positions where the market got it bang on, and the numbers and the fundamentals came at a much later standpoint. So although I don't practice it to that extent, a lot of investors I see use this whole technical plus fundamentals, right? And I think there is merit to it. Again, how do you blend it? Again, I don't have a good idea about it, but I think that's where you're coming, right? At what point? So for the way I'm thinking is these are all different data points, right? There is a momentum aspect, there's how traders are looking at it, there is technical, there's fundamentals. It's at least my conclusion as of today is that it's a question of what weightage you want to give at that point of time for that stock in that context. So it's very difficult to be formulaic in that sense. I could be looking at a company. I'll give two extreme examples. I could be looking, let's say, at a company which has a very, so let's say like an HDFC bank or something. Again, by the way, I don't hold it, but I'm just making it as an example. So I would be looking at that company and saying very high quality, consistent performance, this and that. And I'll give it a little more, weightage on the fundamental standpoint. And I will say, if the market is getting it a little wrong, selling it off, etc., I'll buy it. I will wait on it because the numbers will eventually catch up. So again, have to have a lot of patience. It's like by the time ITC became a meme stock, it is something like that, right? Who knows which stock will become a meme stock, right? But at least, the numbers will catch up and I can give more weightage to the fundamental aspect. But there are some stocks which are so volatile, more than the fundamentals, maybe there are other variables which I should look at. Maybe I should look at the momentum aspect of it. Maybe there are technical aspects I should look at it. And then there are some stocks where the fundamentals actually are more or less unknowable, or maybe it's very tough. Like for example, if you're buying a very highly cyclical metal stock, fundamentals, you will, by the time the fundamentals come through, the story is all done. So maybe fundamentals should get much lower weightage than some other approach. So I am kind of now thinking that it's like a toolkit, right? Which tool do you pull out for which stock in a specific context? And that's my thought process currently, right? So no standard way, just pull these different tools out and start applying them and see, okay, earlier I used to have just this value tool, right? Stock cheap, below a certain point, buy, and then sell. And then exactly the point you mentioned, right? Stock appeared cheap, the moment the fundamentals appear decent, but the stock kept crashing. And then I had no tool in my toolkit to evaluate it on any other parameter. And that's how I'm thinking, right? Like bring all these tools in and think of it from a different angle. Again, weightage, which one we will use in what manner, I think it varies by context and stock.
Yeah, brilliant point. So so process wise, I think we are pretty much covered. I'll just give you a context of why we asked all these questions, right? Majority of the time, first of all, no amount of a couple of hours are not good enough to understand everything around what the kind of working we do. So when we were restarting the podcast, we had a thought that, a lot of time of podcasting goes into background building and all that kind of stuff. And we decided that this time around, none of that sort, unless and until it's really important to the context or it's not available in the market. And we'll go straight to the investment processes and figure it out. Yep. And even then, I still think that we should do more one larger picture session and then one more deep dive into certain nuances.
Correct.
Yeah, and that would be even more important to get.
So
Puneet,
let me share one very I think I would not, I won't call it insight, but something which kind of I came across a few months back. Very good way of thinking about investing. There is this gentleman, and I can maybe share the link at a later point. This gentleman, he talks about learning in different contexts. It's more on, I'm a big proponent of figuring out, how to learn better. So there is this whole thing around wicked domains, right? These are ill-structured problems in wicked domains, right? It's like a very interesting sounding phrase, but what it means is ill-structured problem is where don't even understand the structure of the problem, right? Like for example, right, in our schools and everywhere we go to, we are asked a question, okay, what is 4 plus 2, and you know what the question is, and you can come up with a straight answer. Investing does not have a clear problem defined, and the wicked domain part of it is basically you don't get immediate feedback. So this gentleman, he talks about, how do you learn in situations where the problem is not structured and the feedback is very, it's very delayed, right? Which is what investing is. And, he talks about, games, and I know both me and Manish once played poker also. And, that's a recent obsession of mine. That is partly a structured problem in not a wicked domain, but investing is. So what this gentleman, long story short, what this gentleman said was the best way to learn in such domains is by case study method. Like look at companies, because it's, people talk about this formula and that method and that, but if you're going to do this, you have to, and there's this whole craze around mental models. But what I found is that, unless you know the context, mental models are very tough to apply. I mean, I found I started looking at it and then kind of gave up, because if you don't know the context, you can't go through 150 mental models and what do you do with it. But I found this case study method to be very beneficial. So I think where I'm coming from is your second point, right? That whenever I look at somebody's idea or my own idea, what I will do is I'll take that particular idea out and I will go through the same process which you're going through. How was the buy done? How was the scaling done? What was the sell criteria, and how does it match with the approach I have now? And what are the triggers and what is the context? So I think that's a very good point, right? I think I've started doing that, and I've started making notes of my own, right, where I am looking at my own prior success failure, somebody else's prior success failures, and just creating sort of my own personal case studies. Okay, what went wrong, what went right?
I mean, if you're up to it now, we'll do it again. I mean, we'll get into a session where we'll go into case studies and probably talk more specific processes around. If you're up to it and you're willing to share it, it will be a great session to have. Manish, you had a question.
No, I think during the conversation, Rohit answered it already. So
Perfect.
But this will be fascinating. This discussion of case studies can be another session in itself.
Yeah. So, I mean, absolute great session, Rohit. I'm, parallelly keeping an eye on the time and watch there, and I don't want to stretch it way too much. But it was a great pleasure talking to you again. We're catching up after a long time. Really good to get the insights. We'll again get in touch later on for other things, but absolutely brilliant for the listeners. Probably they'll take away a lot of nuggets which generally gets untalked or unnoticed, in the whole wise gyan world which we live in. Some of the applicable nuggets get lost in the middle of those.
Sure.
Thank you so much for your time, Rohit. Thank you.
Thanks, Puneet.
Yeah, thanks. Great for your
time.
Thanks,
Manish.
Great.
Thanks for having me.
Yeah, Rohit, it was a pleasure having you. Really appreciate it. Thank you.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.